Welcome to the next lecture called Macroeconomic Factors Affecting the Market. Macroeconomic factors provide a crucial roadmap for traders to understand the overall health of the economy and its impact on financial markets. Successful traders integrate macroeconomic insights with technical analysis to anticipate market movements and mitigate risks. Key indicators such as GDP growth signal broader economic conditions, while inflation and interest rates influence asset prices, forex markets, and bond yields. Additionally, employment and consumer spending offer insights into economic health and corporate revenue potential, helping traders assess stock market trends. By analyzing these macroeconomic factors, traders can make decisions on when to enter or exit positions in different market environments. Gross domestic product (GDP) is a key macroeconomic indicator that helps traders assess the overall health of an economy. Strong GDP growth often signals bullish market sentiment, driving stock prices higher as corporate profits expand. Conversely, a declining GDP can indicate an economic slowdown or recession, leading to market downturns and increased risk-off behavior. Traders use GDP trends to adjust their strategies, identifying opportunities in strong economic periods and managing risks during downturns. Strong GDP growth supports equities, favoring growth sectors like technology and consumer discretionary, while declining growth shifts focus to defensive stocks such as utilities and healthcare. In the bond market, rapid GDP expansion can drive inflation, leading to higher yields and lower bond prices. Traders can use GDP trends to adjust their positions, focusing on growth sectors during expansion and rotating to safer assets during economic contractions. Additionally, swing traders can capitalize on quarterly GDP releases to trade indices and sector-based opportunities. Inflation and deflation are key macroeconomic factors that traders monitor to anticipate market trends and asset performance. Moderate inflation generally supports economic growth, benefiting equities, while excessive inflation can erode corporate profit margins and reduce stock valuations. Conversely, deflation signals weakening demand and economic stagnation, which can lead to market downturns and lower stock prices. Traders track key indicators like the Consumer Price Index, CPI, and the Producer Price Index, PPI, to assess inflationary trends and adjust their strategies accordingly. Understanding inflation and deflation helps traders position themselves effectively in different market conditions, whether through sector rotation or hedging strategies. Inflation and deflation play a crucial role in shaping market conditions, impacting different asset classes and trading strategies. High inflation tends to hurt growth stocks by increasing costs, while it boosts demand for commodities like gold and oil, which act as hedges. Bonds often decline in value during inflationary periods as real returns shrink, while forex traders monitor inflation's effect on currency strength. To navigate these market shifts, traders may rotate into value stocks, seek inflation hedges, or capitalize on short-term opportunities by tracking CPI and PPI reports. Interest rates play a fundamental role in shaping market conditions and influencing stock trading strategies. When central banks raise interest rates, borrowing becomes more expensive, leading to reduced corporate profits and slower economic activity, which can negatively impact stock prices. Conversely, lower interest rates stimulate borrowing and investment, often driving stock markets higher as companies expand and profits grow. Traders closely monitor interest rate changes to anticipate shifts in market trends and adjust their positions accordingly. Understanding these macroeconomic signals helps traders capitalize on opportunities and mitigate risks in a fluctuating economic environment. Interest rates have a significant impact on various asset classes, shaping trading strategies in different sectors. Growth stocks tend to underperform when rates rise, while financials and energy sectors may benefit, guiding traders on sector rotation strategies. Higher interest rates decrease bond prices but attract foreign capital, strengthening the domestic currency, which presents opportunities in forex trading. Rising rates also impact real estate by reducing housing demand and property values. Traders can adjust by focusing on short-duration bonds, bond futures, or trading currency pairs based on rate differentials to capitalize on rate movements. Employment and labor market data play a crucial role in shaping stock market trends, providing traders with key insights into economic strength. Metrics like the unemployment rate, non-farm payrolls, NFP, and the JOLTS report help traders gauge consumer spending power and corporate earnings potential. Strong employment numbers typically drive bullish sentiment, benefiting cyclical stocks and sectors reliant on consumer activity. Conversely, weak employment signals economic slowdown, potentially leading traders to rotate into defensive stocks or safe haven assets. By monitoring labor market conditions, traders can anticipate market trends and position themselves accordingly. Employment data has a direct impact on various asset classes, influencing trading decisions across equities, forex, and bonds. Strong job numbers typically boost consumer-driven sectors like retail, while also strengthening the domestic currency and forex markets. However, low unemployment can trigger inflationary concerns, leading to higher bond yields. Traders often use non-farm payroll, NFP reports for news-based trading, as they can cause significant intraday volatility in forex and indices. By understanding employment trends, traders can position themselves in cyclical stocks during strong job markets, or shift to defensive sectors when employment weakens. Fiscal policy plays a crucial role in shaping market conditions, influencing stock prices and sector performance. Expansionary policies, such as increased government spending or tax cuts, can boost demand, driving stock market gains and benefiting cyclical industries like consumer goods and construction. On the other hand, contractionary policies like tax hikes or reduced government spending can slow economic activity, impacting corporate earnings and market sentiment. Traders monitor fiscal decisions to anticipate shifts in market trends, adjusting their positions accordingly. Understanding fiscal policy helps traders navigate economic cycles and identify opportunities in sectors poised for growth or contraction. Fiscal policy plays a major role in shaping market opportunities for traders. Expansionary policies, such as government stimulus, often benefit equities in sectors like infrastructure and construction, making them prime trading opportunities. Increased government borrowing can lead to higher bond yields, influencing fixed income markets, while short-term demand for domestic currency may rise in response to fiscal measures. Traders can adjust strategies by rotating into industries supported by government spending and using hedging techniques such as commodities or inflation-linked bonds to manage risk. Global events and geopolitical risks can create significant volatility in financial markets, affecting trading strategies. Wars, trade disputes, and natural disasters tend to weaken emerging markets and cyclical stocks, making them riskier for traders. Safe haven assets like gold, the US dollar, and the Japanese yen typically appreciate during times of crisis, offering opportunities for capital preservation. Traders can hedge against uncertainty using put options or inverse ETFs to protect their portfolios from sudden downturns. Exchange rates play a crucial role in stock trading, as currency fluctuations impact multinational corporations and trade-dependent economies. A strong domestic currency can hurt exporters by making their goods more expensive abroad, while benefiting importers by lowering costs. Forex traders monitor interest rate differentials and trade balances to identify profitable currency pair opportunities. Commodity traders, on the other hand, track USD movements, as most commodities like oil and metals are priced in dollars, making them sensitive to exchange rate changes. Understanding these dynamics helps traders make informed decisions when trading equities, forex, or commodities in response to global economic shifts. Market sentiment plays a powerful role in stock trading, often amplifying the effects of macroeconomic events. Traders can use contrarian strategies to take advantage of overreactions to negative news, buying when fear drives prices too low or selling when euphoria pushes them too high. News trading is another key approach, where traders capitalize on short-term volatility triggered by major economic announcements. By understanding behavioral economics, traders can navigate market emotions and make informed decisions rather than reacting impulsively. This knowledge helps in identifying mispriced assets and optimizing entry and exit points in trades. Building a solid trading plan starts with identifying the key macroeconomic factor influencing the market. Traders must analyze the current economic environment, whether it's inflation, interest rate hikes, GDP trends, or geopolitical risks to determine market direction. For example, if central banks are raising interest rates to control inflation, traders should adjust their strategies accordingly, focusing on sectors that benefit from higher rates. Staying updated through economic calendars, central bank announcements, and market reports is crucial for making informed decisions. Once traders identify the dominant macroeconomic factor, the next step is determining which asset classes will be most affected. For example, growth stocks may struggle during rate hikes, while value stocks and financials could benefit. Higher interest rates generally push bond prices lower, while strengthening the domestic currency and forex markets. Inflation concerns, on the other hand, tend to drive commodity prices higher, making assets like gold and oil attractive. After identifying the dominant macroeconomic factor and its impact on asset classes, the next step is using technical analysis to optimize trade entries and exits. Key tools include support and resistance levels to identify price reversals, moving averages to track trends, and RSI or MACD indicators to measure momentum. For example, if inflation data suggests higher gold prices, traders should wait for a breakout above a key resistance level before entering a position. Combining macroeconomic insights with technical analysis allows traders to make more informed decisions, improving timing and risk management. Risk management is a crucial component of long-term trading success, helping traders protect capital and navigate market volatility. Setting stop-loss orders ensures that losses are controlled, defining the maximum risk on each trade. Position sizing allows traders to adjust their exposure based on confidence levels and risk tolerance. Diversification across asset classes minimizes exposure to a single macroeconomic event, reducing overall risk. For example, when trading interest rate changes, placing stop-loss orders at key support levels helps limit potential losses if the trade moves against you. This slide presents a trading plan based on macroeconomic analysis, demonstrating how traders can align their strategies with economic trends. With rising inflation as the key macro factor, gold is identified as the preferred asset due to its role as an inflation hedge. Technical analysis is then applied, monitoring a breakout above $1,800 per ounce to confirm a bullish trend. Risk management is integrated by setting a stop loss at $1,750 and limiting the position size to 2% of the portfolio. Ensuring controlled exposure. This lecture reinforces the crucial role macroeconomic factors play in shaping market trends and guiding informed trading decisions. By understanding key economic drivers such as inflation, interest rates, and employment data, traders can anticipate market movements more effectively. Integrating macroeconomic insights with technical analysis allows traders to refine entry and exit points, maximizing profitability while mitigating risks. A well-rounded approach that combines both disciplines leads to better trade execution and more consistent results.